All righty. Good evening, everybody. Just a few more people probably waiting to come on here. I'm just going to wait just a second. All right, guys, welcome to the Hurley Investments Market View commentary of June 5th. Just to get right into it, obviously Kevin is gone tonight. He's at a chaperoning at a youth camp. So I'm taking over for him tonight. To get into our big picture, I'll just get over to their site over on briefing.com that we usually have up here. So a few takeaways. I already got questions. Good. No questions. Just hi. Hi, Abraham. So starting off, going back to last week, we had a shorter week with last Monday, a week ago being a Memorial holiday. So we had the market closed on that day. Nice 3-day weekend. We won't ever complain about those. But during the last week, we did get a few things positive for the market that allowed us to rally into the end of last week, rallied even today, and kind of pared back a bit. This was Friday. We'll go into the chart a little more, but this 41.88 was a tough place to get over, even 41.72. Just this area was tough for the market to get over. And finally, last week, this 4,200 bounced above it nicely. So why did that happen? Obviously, we got our House, Senate, and our government, our president to make a deal on our debt ceiling. That was obviously a positive. Um, not that I believed anything else would happen, but a deal getting done. The market was a little worried about it, and some volatility definitely happened over the last couple of weeks. You can see this hitting the 4,200, going all the way down to 41. Just 100-point swings in our S&P over the last couple of weeks because of this issue. On that note, I do think even Warren Buffett has come out and said that this shouldn't be a bargaining tool using the debt ceiling. He's said that for a long time, but I kind of feel like each time this happens, it's sort of an inevitable. Nobody wants or expects on either side of the political aisle for a deal not to get done or to really risk defaulting on our debt. But I kind of disagree with I don't know, some of the talking heads and some of the people that don't like that this is a negotiating tool. I feel like it's an important place where both sides can find a way to compromise, because there's really no choice. I mean, they have to. This is one of the few times where each side really can push what they want, and they also have to compromise to some degree. Not that I feel that that's great all the time, but for something like this, Republicans coming and saying, hey, we need to start spending less. This is ridiculous. And I feel like that is a positive thing because our government is just spending too much damn money. That was the first reason we had the breakaway above 4,200. Another one was expectations on a rate hike in June. Initially was up from this FedWatch tool that had said there was a 70% probability of a 25 basis point rate hike for the June meeting that's coming up. But they got that because one of the Cleveland Fed President Mester said that there was a likely rate hike in June, but that Fed chair does not actually vote in 2023. So kind of a mute point. And then two other, not Fed chairs, but what are they called? Fed governor. These two guys, Fed Governor Jefferson and Harker, came out and said there's good reason to believe that the Fed is going to pause or skip the June rate hike, meaning they're not going to raise rates in June, but still left the possibility of July, so that they were careful not to make it sound like we've reached the top of our rate hiking, but did indicate that skipping June to kind of assess this, what they've done so far was a good idea. So that was another reason volatility came off, market head higher. I already talked about this a bit. S&P 500, tough time getting over the 4,200. They're just highlighting some technical stuff where we're seeing these points of higher lows right here, higher highs. We'll obviously come back to charts a little more. The other couple of reasons were inflation data. Inflation data this week was slightly better, not amazing, but slightly better. Continuing on with that idea, employment data remained solid for the most part and kept recession current concerns at bay. So, in other words, the job market is cooling off slightly, and I'll let you guys read the details of why, but not tanking. Jobless claims well below what is typically seen as a recession environment, i.e. north of 375,000 jobless claims. So once it gets into that neck of the woods, that's more of a worry, but we're not there. We're at 232. We increased just 2,000 on our jobless claims. Not a huge jump, but that coupled with the ISM employment index going up, which represents faster expansion in employment. Not much though. More job openings versus 9.7 million in March. All to say basically that there's a chance, or a better chance, that we are kind of starting to see a quote unquote soft landing that the Fed is hoping to make. They want employment to cool off. but they don't necessarily, well, they obviously don't want a recession. Not sure again if that's going to happen. I have my doubts, obviously, but at least some data economic wise has come in to say, at least indicate that that might be what's happening right now. What it all means, this is a good recap, or not a recap, but just kind of a simple explanation. The concise answer as to what it all means is that it has been a very good week for the stock market. We don't see any reason to expound on things beyond what we saw this week. Sometimes you just have to be happy with what's in front of you. This may have been a shortened week of trading, but it also not. It was long on constructive developments that rightly translated into nice gains for the broader market. Pull from here won't be easy, especially with the possibility of another rate hike, if not more, from the Fed and valuation angst still in play. Yada, yada, yada. All I want to continue, or I guess all I want to comment from there is what was the next high we were looking for? Are we going to continue with that this week? We'll get into that down here. First, though, wanted to talk a little bit about some numbers once again. Had someone come to me a few weeks ago talking about how their preference to just go to indexing the stock market rather than trying to find a fancy mutual fund, or rather than doing this or that. I was told because the market had such a great average return, that it made so much more sense to just stick with indexing the S&P 500. And because I'm such a good guy, I went through and explained the difference between average growth, average returns, and real portfolio growth. Guys, you've heard us talk about this time and time again. Let me just explain a couple things. First of all, I don't know where they got 13.6 average return over the last 10 years. You can see I've got the numbers here for 2013 to 2022. Obviously, we're still in 2023, so we're not worried about that one yet. But that's 10 full years. By my math, was closer to 12.5%, but just for the sake of argument, I took their 13.6 average return. The whole reason they were basing this off of their decision to index the stock market. So what are we talking about when we talk about average returns? Anyone want to explain this in a short sentence? Give me a quick sentence that explains what we're talking about with average returns. Dave. Thank you, Dave. Dave says you take the number of years, you take the difference in price from the starting year and the ending year, and you divide it by the number of years to get an average. Yes. Thank you, Dave. I'm just going to put that. So you take the return, the total return, take the total return over that period and divide. Maybe I should spell divide correctly. Divide that by the number of years that gives us an average return. So the thought process is that, hey, if I want to get an idea for where such and such investment is going, I'm going to take the average yearly return. In this case, the S&P 500. I'm going to go back 10 years so that I can get a decent idea for where the market is headed into the future. So the idea of taking average return over a number of years is thought to give us a decent understanding of where, my goodness, the market will go in the future, right? Because we know the market goes up and down, but we just kind of want to get an idea somewhere in the average in the middle where it goes. Seems fair, right? Ooh, I don't want to do that. I want to do this. Why is this complete nonsense? So here's our year. All I did was take a spreadsheet from the interwebs across all these years, shows us our prices, shows us our yearly change, down 19% on one year, up 19% one year, ooh, up not 29% in 2013. So I took these and all I did was took a hypothetical $1,000 that we invested in the stock market And this side, you can see our portfolio of $1,000, how it grows based on a 13.6% average yearly return. And this side, I took the same $1,000 and showed how it changed based on the actual percentage movements of each of these years in the stock market. So why do you guys think? Some of you guys should know. I know you know the answer because we talk about it an awful lot. Why shouldn't we use an average return versus a real growth return? Here's our ending number. If the market had really gone 13.6% every single year, we would end up at 3,579. Boy, that sounds great. But in reality, our $1,000 starting in 2013 is almost $1,000 less, sitting at 2,692. So definitely up. Quite a difference between the average return and the real return. How can this be? All right, Abraham says, because one year you can have 100 and the next 0, and the average is 50, but you stop existing. I think you meant a different word there. You stop. I'm gonna have to guess, Abraham, what you're referring to, but yes, your average is 50, but your growth is not. Yes, I see what you're saying, Abraham. You have less money. It's not gone, but you're talking about the story of a dollar that we talk about so often. Jim, yes, you're right. Market, what the average does makes it seem like the market is linear when you can see by these numbers that it's anything but. And I think these numbers are actually somewhat incorrect from wherever I got them on the internet, because the S&P ended up 14% in 2020. I know that. So maybe they're throwing in dividends or something. I don't know. But it's close enough. Even if we went to a 12.5% average return, we're still going to end up at a higher number here in our average side than we will in our real return side. Let me just take a picture. I'm just going to put it in here. Yes, and Abraham said the average can give the wrong impression. Obviously, not just the wrong impression, but Geez, the whole wrong idea. So my reason I'm going to say here is the market doesn't compound at its average return. What do I mean by that? Going back to this, we've averaged across all these years and said our yearly average is this. It does not compound at that rate. It compounds at the return for each year. So this first one, hey, we're ahead because 29% growth the first year in 2013 looks excellent. We're actually ahead by over $100 than we are on the average. Still ahead of the second year in 14. But what starts to happen once we get the first negative year, 2015, this year, we had a negative compounding return. This year, we still had a really big 13.6 compounding return. That's where things start to change. It doesn't compound linearly. So, what's the problem with this? The problem is if you expect the market to do in the future what it did on average in the past, your financial plan is going to be way off. Your premium financed insurance policy that's supposed to grow and pay for itself because there's this invested portion of this insurance policy, this life insurance policy, where the market grows and your portfolio grows and then pays off the premium and supposedly pays off the premium and the interest on your life insurance policy. Well, once we get one of these negative years and it doesn't give us this average linear return one year, this policy is screwed because they want you to take it out of your pocket and pay those premiums. This is a multi-billion, hundreds of billions, if not trillions of dollars in these whole life insurance policies, all of the stupid names they have, universal life and whole life. It's all just completely bogus because they say, oh, well, look, our world index for the past several years has been this great, amazing 13% return average. So, you know what? We can conservatively say that this policy should be able to pay for itself at a 9% return. Except that it doesn't do that. It just doesn't. Once you get one of these negative years, that policy is screwed. And, I apologize if I'm being a little blunt, but this garbage is peddled by guys with my license, with insurance licenses, to be able to sell this to clients. And they get paid up front, really nice. But they just don't work. Even if they don't go belly up, which in my experience, the ones I've seen are causing huge financial issues for people that I know. Even if that doesn't happen, it is not going to work out the way it's supposed to. And it is highly likely that the client is going to have to pay at some point to the tunes of hundreds of thousands of dollars in premium payments whenever that average linear expectation doesn't work out. But aside from insurance, it's a really poor way to decide or to plan your financial future around this idea that it's going to meet this average return. And the only reason they do that in reality, right, because it seems fair to just take the average, but the reality is any financial plan that you've been given, you're being charged for the financial plan. That's based off of linear average returns. That's why you see those pretty graphs on those financial plans that show here's your starting number, and there's these nice long curving beautiful lines that go up and tell you in 10 years time this is where you should be. The problem is it doesn't ever go that way. Certainly it's possible over a 10-year period that it could still average whatever return it had the previous 10 years. But what if you are retired? What if you're retired and you really have about 10 to 20 years left to use the money that you have? You're expecting to be able to see your portfolio grow at a linear rate, and then you get a down year. Like last year, you get a really crappy down year. The problem is you're also taking from your portfolio, and it's not compounding like you hoped it would. Does everybody understand what I'm saying about compounding? 1 year, you have more. The next year, it compounds with more on top of that. But if it's negative, it's a negative compound. So what happens? Well, the financial planner says, oh, well, all right. It's not going the way that we thought it would. Let's readjust your flight plan. Let's print out a new flight plan with new linear returns, with putting your money into different mutual funds and different things that are supposed to be better because they have better average returns. So now we're going to get it right. And year after year, this BS continues to happen, which is why we don't do this. We're realistic in what we say. This doesn't happen. The only way you can beat the market average is if you dollar cost average, meaning that you have money to buy the dips, to lower your average cost. So when the market does go up, you have more shares working for you. How do we average? How do we dollar cost average? We use puts to protect on the way down. We cash in those puts like an insurance policy, protecting our stocks. We buy more shares. We dollar cost average without asking clients for more money. In this way, we can deliver better returns into the future. We can take advantage of these swings in the market. And we can do better by our clients. Guys, is there any questions? Kind of a long rant, but man, I guess you can tell I'm pretty sick of investment advisors peddling this stupid idea and charging people for it. Any questions on this before I move on? All right. Feel free to write in a question. I'm going to move on. Where will our markets end this week? So with the news that we've had that I went over at the beginning, I feel like we could go higher. The but is the higher point that I thought we could get to was this 4,300, which we touched that today. So I feel like we're going to be battling that number for the rest of the week at least. We might even pare back a bit. So we got those two things fighting against each other. Looking at a longer term chart here, let me zoom in. You can see where I'm talking about summer of 2022. We had a nice rally up to that 4,300 level, and we're just touching that now. But we've got, as that article said, higher highs up here, I should say, higher lows. That's indicating a somewhat bullish trend. I think we could probably head up in through June, but it's a hard guess to make as to whether we'll do that this week. I feel like we probably could. So I said higher on where we'll end, because I do think we'll keep testing that 4,300 and possibly break it with the decent news we've had. Not that I think it will go crazy, but those are my thoughts. What do you guys think? Here's our industrial average. We have up to, get up closer to 34,500. So we've got some room there. Talked about our S&P. We're kind of at that 4,300, almost to overbought, not quite. Could see something in this nature. Let me go back to the actual chart here. Hit this number, 41.35, kind of paired back in a few days, and then started to rally back up over a couple of weeks. But you can see that 41, and again, the 42 over here, took a while to get over that. But the reasons that it took a while are also a little more sorted, at least sort of sorted. NASDAQ, nice rally. NASDAQ's overbought. So again, I feel like maybe a couple days we'll pair back, maybe go sideways before we start to head back up. We're kind of already up 2%. Where will we finish? I still feel like I'm going to go with 6. I think this was supposed to be 6. Kevin had given this to me. I think that was for last week. This week is the 5th. He can correct it next Monday if he has to. I'm going to continue with plus 2%. Once we get that confirmation that our rate hike is truly going to be paused, I think we could head up higher. But that is the next thing, and the expectation, as we talked about, is that they will pause rate hikes for June. There are a couple earnings, but not from companies I thought were relevant. Just a couple of them. Economic reports. We had the ISM index today. Let's go back to that week. So this is it's basically a survey of businesses. Non-manufacturing just means that this is more of the services industries. And a cooling down of this to 50.3 from 52.5. 50 is the median. Anything above 50 is more growth. Anything below is less. So because we had pared back from the prior of 51.9, that was somewhat of a positive. I really think the only reason we pared back towards the end of the day on our market is because we hit the 4,300. Had a couple of really good big days in the market, Um, we've got consumer credit, one that everybody is watching, although as they say, it's fairly low. I feel like it's somewhat more important than low impact. Oil inventories, these things are going to tell us a little bit about our inflation, what to expect there. And then Thursday, we get employment numbers, which everybody has been keeping track of. Moving on from there, pretty awesome little article that you guys should check out once this is posted. Apparently, Cathie Wood's ARK Invest misses out on Nvidia's powerful rally, dumped the stock too early, citing high valuation. Let's look at Nvidia. It was up 26% after their earnings. Can you freaking believe that? From 303 all up to 391. Just insane. Way overbought, kind of going sideways a bit, but holding the gains. And this lady, who everybody thinks is the biggest genius on the planet right now, completely missed out on it. Bill, that's exactly right. Bill said, looks like Cathie Wood stepped in it again. Couldn't have said it better myself, Bill. I'll let you guys read this, but I guess the main point that I thought was interesting that I wanted to highlight is this is why you buy and hold your stocks and you use puts to protect your stock, to protect your shares of stock, rather, so that you can be in it for these ridiculous moves up when the market finally starts to see that something is really cooking and a bunch of funds start to pile money into it. Obviously, it's not NVIDIA for us, but we're in it for Disney. Could get all the way back to 200, trading at the same price basically that it was in when the whole world was shut down in 2020. Their parks were shut down. All they had was their streaming they could rely on. And we're today, with all the money and all the opening and all of the stuff that's happened in the last 2 years, we're trading at the same price. The same price Disney was at when the world was shut down. That seems rather silly. Apple, on the other hand, has touched their all-time high number around 185. It might have been a little higher, I can't remember, but a couple years ago that was where they were at. Um, it's going to struggle most likely to stay over or to get over that number, but they they just uh, they just revealed their new what do they call it, the Vision Pro. It's a headset you put over your eyes, allows you to see through to see the environment around you, but have augmented reality kind of little apps and screens that you can see in front of you as if they're in front of you anyway. $3,500 for this thing. Um, kind of crazy, but this is usually what happens when Apple comes out with their worldwide developer conference thing. Real big hype going into it and then falls towards the end of the day, which is exactly what happened. And I think this has got to be similar to what's going on in the broader market, similar to what's happening in the Nasdaq. Nice run, hitting a price that previous high, and might see some paring back for a few days before it continues up, would be my guess. This will be an interesting week to see what happens. With some decent news, however, some earnings that we just went through that really, some were great. Obviously, NVIDIA was nice. Some were not so much. It'll be interesting to see what the market justifies to allow the indexes to continue up above some of these resistance levels. Guys, is there any questions? That's it for me, unless I have some questions to answer. Doesn't look like anything's coming in, but you guys, I appreciate you coming tonight. Always enjoyable. Glad to see a good turnout. I believe we should see Kevin next Monday. I will be doing the Thursday trade findings and adjustments, so hope to see you guys there, 10 a.m. Mountain Standard Time, if you can make it. Thanks, guys. Thanks, Abraham. Thanks, Jim. We'll talk to you guys next time. Take care.